So I've obviously just pulled over here. Big news going on. Still in a car park, but Pat,
Exactly.
I thought I'd bring you on and we talk about what the fuck is going on.
You know what? I said, Danny, pull the fuck over. We got a live stream because this is getting spicy. It's spicy, buddy. Like this ship between Trump and Powell is going next level. It started, and let's talk about a storyline of what happened and how this has been playing out. So it started back on April 9th, in my mind, when we were already in the midst of clearly a market contraction, and we saw the markets diving. Things were getting really messy out in the markets. All of you saw what was going on in those first few weeks of April, and there was the FOMC meeting minutes. It came out on April 9th in the afternoon, and there was zero dovishness coming from the FOMC statement. It was clear that they were still worried about inflation risks and stagflation and all of these things that they were anchoring off of, and they were not accommodating. And this became a double down earlier in the week when Powell was speaking in Chicago. He was speaking at the economic outlook for the Economic Club of Chicago. And so he's out there, and again, he reiterates the same points. And so we have a situation: is inflation really as big of a problem that the Fed should not be responding and be accommodative to this type of a market environment? And this is where it's really interesting. Is the Fed engaging in policy error? But it's not just that is it policy error, but are they doing it intentionally to drive a recession? And one of the things that to kind of collaborate this, actually, Zero Hedge has been on this really well in the last little bit. Let me actually quickly share an image here. This is a great image right over here. But basically, this is showing the Bloomberg financial conditions. And it's showing that what were the financial conditions. The zero line was also where the elections were. And what you want to observe is that the rate cuts that Powell has done were done when financial conditions were better. Yet here, in the first weeks of April, we had a complete collapse of the financial conditions, at least based on this metric. And Powell doesn't seem to be worried. Okay, why? Why should they not be concerned or worried about this? And why are they so concerned about inflation? Now, almost for certain, everyone's, tariffs. How many of you thought tariffs? Right? Well, that's going to cause inflation. Prices are going to rise. The Fed has to act. No, I'm going to stop everyone here. I'm going to be very clear about this. There are two types of inflation. Two types of inflation. There's monetary inflation, and then there's supply shock inflation. Supply shock inflation is tariffs are a supply shock inflation. And supply shock inflation is the very definition of transitory. In other words, yes, prices will rise when you implement tariffs, but you don't fight a rise in prices by tightening monetary conditions. It's not the correct response, right? Tight monetary conditions to fight inflation is when there is too much credit and money being created in the system. All right. Too much money and credit in the system. A perfect example here. Let me just share the screen. This is using the Federal Reserve Bank of St. Louis Fred economic data system. And what you're looking at is the growth of M2 money supply. What I want to highlight in gray is what was the COVID crash and subsequently recession that was very much triggered by governments shutting everything down. Now, when you shut off the system, how do they restart the economy? And they decided to restart the economy by literally creating ridiculous amounts of credit, PPP loans, and all these other things that were created to inject money, often backed by the governments, in given to consumers and to businesses to spend. Now, I want to you all think about this. Since they've tracked money supply, it has grown from $1 trillion to $2 trillion to $5 trillion up to $15 trillion pre-COVID. Literally in a year and a half, 2 years, money supply went from 15 trillion up to $22 trillion. Basically a 50% rise in money supply. This was a reflection of them just literally creating credit and punching it in the system. Well, shockingly, monetary inflation of that manner was a huge contributor to the CPI inflation that we had running near 9% at the tail end of that. But what has money supply been doing? What has been monetary expansion? How's credit expansion been in the last 2 to 3 years since then? It's been flat. We've stayed between 21 and 22 trillion dollars consistently. Point is that we do have sticky inflation. We have inflation that is up there, but it's not being driven by monetary expansion. And this is the key. Therefore, monetary policy, the idea of keeping it tight to fight and slow down this enormous money supply expansion, that's not there. It's not there. So why is the Fed insisting on being so tight? And this is the really interesting, it's not necessary. I don't want to call it a conspiracy theory. I want to, here, I'll just quickly show this article. This was from 2019 during Trump's first presidency, where Bill Dudley, formerly of the Fed, came out with a column on Bloomberg. And the headline is, "The Fed shouldn't enable Trump when it comes to tariffs." This was a policy that the Federal Reserve itself had, at least members within it had, of what the situation was. And the point is that you can go on and read on the whole thing, but the point is that they're saying by them easing, they're basically empowering or enabling Trump. And so what the question is, as Trump is making what he thinks are critical decisions, whether you support Trump or don't support Trump, it's not the point. I'm not here to defend that. Point is that Trump is an elected official that has a mandate, and the mandate was given to him, and he's acting upon it. He's doing the agenda that was set out. And the entire system should be trying to work in equilibrium as these adjustments are being made. And the fact is we're simply not seeing that. The Fed is literally saying, we're just going to chill and see what happens. So what supports this idea that there's a policy error? Well, one thing for sure is that you can at least come to some simple conclusions. Number one is that we have seen very clearly over the last 5 years that there has been strong correlation with monetary policy amongst all global central banks. When the Federal Reserve was raising interest rates, so were all of the other countries in the world. Canada was raising interest rates. Europe was raising interest rates. Everyone was raising interest rates. And in the past year, everyone paused, or the last 2 years, they paused raising interest rates at the same time. And they even started cutting interest rates at the same time. And yet, Powell says, we have to see this inflation looks a little sticky. And yet you have the ECB, Bank of Canada, all of them. They're all cutting. Just again, the ECB today, cut again. Why? Because they know that they need to provide the stimulus. But why is the Fed not doing it? And this is where it gets spicy. What you can clearly see is that now Trump is getting involved. And this is why we had to do this live stream now. Because right now, literally, Trump is coming out and basically criticizing Powell. He's basically saying his termination can't come fast enough due to his reluctance to lower interest rates. So you have a situation where the Fed is basically not willing to participate, and Trump is basically coming in here and saying, you guys need to cut. So the question is, the policy error by the Fed going to be big enough or strong enough to actually exacerbate a potential recession risk? We're like over 50% probability based on poly markets of being in a recession or going into a recession this year. We continuously are seeing conditions worsening, and Powell is not reacting. And so if he is too late to react, Trump called him always too late and wrong Powell, is his new name. And so you can clearly see this. There's contention here. They're trying to find a way of putting in someone at the Fed that is a team player, you can kind of say. So my big question, the big question, A, is there a policy error? And I feel, yes, there is a policy error, and it is increasing the likelihood of a recession. So the question then becomes this: how do you make money off of it? And this is where there's a couple of ways to place this trade. Now, first of all, let's talk about the most obvious one. And the most obvious one is interest rates. Now, I'm going to talk briefly here about SOFR futures. And we don't have to all make you futures traders, but SOFR was the former euro dollars. It was where you could trade interest rate trends on short-term money. And so this is where the market more or less speculates as to where interest rates will be over a short period of time. This particular chart we're looking at is where interest rates are trading, anticipating interest rates to be at the end of the year on December 2025. Okay. And so what we're seeing here is that we're pricing 3.5% interest rates, or just over 2 rate cuts that are potentially being priced in this year. Now, what's crazy is that, fine, okay, maybe we're almost halfway through the year. Well, not halfway, but we're in the second quarter of the year. So, maybe they wait a little bit. Maybe 2 or 3 rate cuts is something that can potentially play out. But if we are heading toward a recession, if you are listening to this and you believe that the chances of a recession is greater than what the market is anticipating, then there is a legitimate chance that the Fed, when like Trump's nickname for him, always too late and wrong. So if Trump is right and they are making a policy error, then the Fed is going to have to cut that much more to counter the fact that they were late. They're going to cause some sort of a problem by keeping conditions too tight. And that could trigger them to have to cut deeper and farther than everyone expects. So this is where I want to go to a chart. Look at this. When you go to December of 2026, they're still pricing interest rates to be let's round it to 3.25, 325 basis points. Now, that means that the market currently is not pricing a Fed doing any aggressive easing. But yet, if a recession is triggered, is it out of line? Is it out of the realm of possibility that they may have to cut down to 2% or 1%? Now, I'm not in the camp where we have to go back to zero, but do you think it could be more than 3 or 4 rate cuts? Because if you're in that camp, then these SOFR futures are an opportunity. Now, some of you don't want to play the futures market and don't know how to put on these types of trades. There is actually a really interesting way to play it. These SOFR futures tend to, especially in this kind of time frame of 1-2 years out, correlate with the 2-year Treasury bond. And if you look here, there is a great product put out by Simplify that is playing short-term treasuries, but on a leveraged basis. So rather than getting the small amount of volatility that you would get with a typical 2-year treasury, this allows you, like a double or triple exposure ETF, to get extra exposure on the 2-year treasury note. And so arguably, if you're in the camp that there is very likely going to be a recession, a slowdown, and the Fed will have to cut more than they're currently pricing in after this is proven to being a policy error, then this should rip to the upside. And that is a number one way for a trader to play directly into it. But then you could play the knock-on effects. You could play the fact that, well, typically during a recession, you're going to have corporate earnings contractions. You're going to have corporate earnings drop 10 or 20% versus growing like everyone is pricing in. So during recessions, when corporate earnings contract, stock markets decline. When there is no clarity on those earnings and how they're going to be playing out, the multiples are taken out. We were trading at a 22 multiple on the S&P. And yet, for instance, the 10-year average was something like 18, or the 30-year average like 16 multiple. During a recession, them removing the PE, the multiple that they're paying for their PEs, can exacerbate the decline of earnings. And so you could have a scenario where corporate earnings decline by 10%, but then the multiple goes from 22 down to let's say 16, and you're talking about an S&P that's under 4,000, another 20+% lower. So you need to play defense, whether you protect your portfolios, whether you want to speculate on it and you buy options to bet on the downside like we do at Big Picture. You can turn around and express this trade in numerous fashion. And this is 100% what we're going to try to accomplish. So this is, like Danny, I was talking, buddy, this is so spicy. The fact that we've got this clearly this Fed that is essentially intentionally pausing. I think they're intentionally doing it. It's going to be proven to be policy error. And Trump is going to war against Powell, and he basically wants him removed. And so we've got this drama. And the important thing is, well, what is the impact of that going to be? And that is 100% what we're going to be tracking and watching. You know, we're going to cover it on this channel nonstop. But grab some popcorn here, buddy, because this is going to be entertaining over the next little while. Now, let's open it up. Is there any questions or anything? What do you want to address, or do we just wrap it?
I think most people are agreeing with you, Pat. So
It's
I don't think there's any questions because I think most people are agreeing with you. So I think I think it's good. I think, you know, we're going to be covering this nonstop. We're going to be looking into this way more. So I think this is a good place to wrap and as a good start. And
absolutely. You know what? Listen, there's a lot of interesting things I still want to cover. Maybe we'll have to do another one of these because, you know, I think that there's a lot of really interesting things that me and you need to talk about with our listeners, just
yeah,
about like how things play out. Obviously, recently there was also Ray Dalio coming out and talking about the concerns he has about where we are in this economic cycle and that it could be severe. I like that in itself is a whole conversation on its own. Then on top of that, gold is ripping. We got to talk to everyone. What's the opportunity in gold? Like,
yeah,
listen, stick around, everyone. We're gonna have so many more great conversations on this. And this, you know, we follow this stuff every day at Big Picture Trading. You know, free trials are available on there, so you can check that out as well. But I know, thanks to everyone for joining the live stream, and this was awesome. We're gonna do more of these.
all right, cool. See you later, guys.
All right, thanks everyone.